Hello everyone, and welcome to my channel, where we separate stock market fact from fiction. Today, we're diving into a topic that affects every investor: Top 10 Stock Market Myths Debunked. You've probably heard these myths from friends, family, or even the internet, but are they really true? Stick around as we debunk these misconceptions and set the record straight. If you're new here, feel free to subscribe and hit the notification bell to stay updated with our financial insights. Now, let's get started. Investing is like gambling. This is one of the most common misconceptions about the stock market. Many people liken investing to a high-stakes game of chance, where success or failure depends on luck. In reality, investing is far from gambling. While both involve risk, the key difference lies in strategy and knowledge. In gambling, outcomes are largely determined by chance. You bet on a roll of the dice or the spin of a roulette wheel, hoping that luck is on your side. In contrast, investing is about making informed decisions based on research, analysis, and understanding the companies or assets you're investing in. Investors analyze financial statements, market trends, and economic conditions. They diversify their portfolios, manage risk, and have a long-term perspective. While there are no guarantees in the stock market, the element of strategy and knowledge sets investing apart from gambling. Timing the market. Another persistent myth is the belief that successful investing hinges on predicting the perfect time to buy or sell stocks. In reality, consistently timing the market is an exceedingly challenging, if not impossible, endeavor. Market timing involves attempting to forecast market movements based on economic indicators, world events, or even gut feelings. Even experienced investors and financial professionals struggle with this approach. The stock market's daily, even hourly, fluctuations make it unpredictable in the short term. Successful investors generally adopt a long-term perspective. They understand that the stock market's history is one of overall growth, despite occasional downturns. Trying to time the market can lead to missed opportunities and costly mistakes. You need a lot of money to start. This is one of the most pervasive myths about stock market investing, and it can be discouraging for individuals with limited funds. Many believe that substantial wealth is a prerequisite for entering the stock market. The reality is quite different. In today's world, investing has become remarkably accessible. There are numerous options for investors with varying financial resources. You can begin with a sum that you're comfortable with, even if it's a modest amount. Fractional shares and low-cost online brokerage accounts have opened the door to investing for individuals with limited capital. Moreover, regular contributions over time can accumulate into a substantial investment. The key is to start early, be consistent, and harness the power of compounding. Regardless of the amount you begin with, the critical factor is your commitment to investing. It's all about luck. Some people believe that success in the stock market is solely a matter of luck. They see stock investing as a form of gambling where you're either fortunate or unlucky. This myth often discourages potential investors from taking their first steps. In reality, the stock market is not a casino, and investing isn't a game of chance. It's a platform where businesses raise capital, and investors buy a share of those businesses. Success in the stock market isn't determined by luck, but by informed decision-making, research, and patience. Professional investors rely on thorough analysis, financial ratios, and a long-term perspective to make investment choices. While market fluctuations and short-term outcomes can seem unpredictable over time, the stock market generally reflects the growth of the underlying economy. Long-term investors who adhere to a well-thought-out strategy and are patient with market fluctuations have historically been rewarded. Diversification doesn't matter. Some investors believe that diversification is overrated, thinking that focusing on a single stock or sector can bring them higher returns. This myth often leads to concentration risk, where all of one's investments are tied to a particular asset or industry. In reality, diversification is a fundamental principle of risk management in investing. It involves spreading your investments across different asset classes, industries, or geographic regions. The goal is to reduce risk and potential losses by not putting all your eggs in one basket. Diversification can protect your portfolio from the poor performance of a single stock or sector. While it may not eliminate all risk, it significantly lowers the chances of a substantial loss. Most seasoned investors understand that diversification is a prudent approach to preserve and grow wealth over time. The more information, the better. It's easy to assume that having an overwhelming amount of information is the key to successful investing. Many people believe that the more news, analysis, and data they have, the better they can predict market moves and make informed decisions. However, this myth can lead to analysis paralysis. Overloading yourself with information can be counterproductive, causing confusion and indecision. In reality, the quality of information is far more important than the quantity. Successful investors focus on relevant and actionable information. They understand that markets are influenced by numerous factors, not all of which are immediately relevant. What's crucial is the ability to sift through the noise and identify the factors that truly impact an investment. Furthermore, the availability of information doesn't guarantee an edge in the market. Investing is only for the wealthy. One common misconception is that investing is exclusively reserved for the wealthy, and that individuals with limited funds need not bother with the stock market. However, this belief couldn't be further from the truth. Investing has become more accessible than ever, thanks to advancements in financial technology and the availability of low-cost investment platforms. You no longer need a large sum of money to begin your investment journey. In fact, starting with modest sums and consistently contributing to your investments over time can be a highly effective approach. This is known as dollar-cost averaging, and it enables you to spread risk and potentially benefit from the power of compounding. Over time, even small, regular investments can grow significantly. Moreover, there are various types of investments suitable for individuals with different financial situations. You need a financial advisor. Another prevailing myth is that you must have a personal financial advisor to invest effectively. While financial advisors can provide valuable insights and guidance, especially for complex financial situations, they are by no means a requirement for every investor. Thanks to the wealth of information available online and the proliferation of user-friendly investment platforms, many individuals successfully manage their investments independently. This approach, often referred to as DIY, do-it-yourself investing, allows you to take full control of your investment decisions. In recent years, robo-advisors have also gained popularity. These automated platforms use algorithms to create and manage a diversified portfolio based on your financial goals and risk tolerance. Always follow the crowd. The misconception that following the crowd is a surefire way to succeed in the stock market is a potentially costly myth. Many people believe that if everyone is investing in a particular stock or asset, it must be a winning opportunity. However, this herd mentality can lead to poor investment decisions. The reality is that the stock market is driven by a wide range of factors, from economic data and corporate performance to geopolitical events and investor sentiment. What works for one investor might not work for another, as everyone's financial situation, goals, and risk tolerance differ. Investors should be cautious when following the herd, as it can result in inflated asset prices that eventually experience significant corrections. The dot-com bubble of the late 1990s and the housing market crash in the mid-2000s are prime examples of herd behavior leading to financial disasters. You can get rich quick. The lure of getting rich quickly in the stock market is a dangerous myth that has misled many aspiring investors. This notion often goes hand in hand with the misconception that investing is akin to gambling, where a single, well-timed trade can transform you into an overnight millionaire. While there are exceptional success stories, they are the exception rather than the rule. The reality of investing is that it's a long-term endeavor that requires patience, discipline, and a well-thought-out strategy. Wealth accumulation through investing typically occurs gradually and systematically. Sustained success in the stock market is more about building wealth over time, rather than seeking rapid, unsustainable gains. Attempts to get rich quickly often lead to impulsive, high-risk decisions that can result in significant losses. And that's a wrap on Top 10 Stock Market Myths Debunked. We've unraveled these common misconceptions, and hope this video empowers you to make more informed investment decisions. Remember, the stock market isn't a place for myths. It's a place for knowledge and strategy. If you found this video helpful, please give it a thumbs up and share it with friends who might benefit from the insights. For more finance-related content, subscribe to your channel. Thanks for watching, and we'll see you in the next video.